welcome to this week's video. Bill, good to see you. Good to
Thank you very much.
Okay, let's start with the Fed minutes on Wednesday. No big surprises, but what's your sort of view on inflation?
Well, I think the interesting thing is probably for you youngsters in the market, today is the first anniversary of the Bernanke put, if you want to call it, okay? Because he confused us a year ago in March when he said, well, we're going to eliminate QE, and everybody panicked, especially emerging markets and selling the bonds. Well, a year on, he's basically doing what I think everybody expected. And I think last night's meetings were, I think I watched a commercial on P&O Cruises rather than looking at the minutes. So it told us nothing different than what anybody is expecting. And I think the interesting thing is, and maybe I'm moving too much ahead of ourselves, is the next Fed meeting, okay, will be the week after ECB rates decision on the 5th of June, Bank of England, and of course, non-farm payrolls on the 6th. So I think the market said, well, they didn't tell us anything more. And of course, since the meeting, Janet Yellen has had 4, again, sort of, I'm not saying meaningless speeches, but basically sounded no difference in being ultra. But I think one of the interesting things that we have seen in the past year is, except for the Indonesian rupee and the Korean won, every other emerging currency is below to well below where the levels were, when Bernanke made his comment a year ago. And I think the interesting thing is, and we've seen, at that time, especially in March, it was, well, bond markets, sell the bond market, and we even had somebody, a major account on Bloomberg television said, he was concerned about, the Treasury 10-year going to 3.25, 3.5, and that company is sort of, they've had a split in management, if you know who I'm talking about, okay? And I think the day after that happened, we had one major account come on, both Bloomberg and CNBC, basically said, 3.5, 3.25, I'll buy every 10-year in the world. That's even now, okay? One of the reasons why the dollar is still having difficulty, is the Treasury 10-year still hovering around that 250 level. And if you look at 247, that is an extremely important technical level. I know nothing about technicals, on where the S&P, okay, is the S&P rich and cheap, and the Russell 2000. So that, from a technician standpoint, 247 is really the level they're looking at for the Treasury.
And so, with the Dow index sort of buoyant at sort of quite high levels, I would imagine still, where would you see the risk coming from in the sort of forthcoming weeks?
Well, I would see the risk not from levels, but rotation. I mean, when we saw that the sell-off, it was people selling tech stocks, people selling pharmaceuticals. So, but then you go back to a year ago, they were probably selling Tesla Motors. I mean, a year ago, Tesla Motors was, is there a bid for Herbalife? So I think that's where clients need to be attuned to. Not so much selling, quote, the index, but selling parts, I think with the Dow transportation, the last 2 or 3 days is, again, set a level. And I think, again, which makes it probably difficult, if you really want to know what's happening in the U.S., you have to look at the Russell 2000, okay? I mean, we look at the Dow, it's at 30 stocks. It's like the FTSE. Remember, 77% of the companies on the FTSE, more than 50% of their earnings are made outside the UK. And so, probably, and again, we saw what happened. Look at the AstraZeneca-Pfizer situation, okay? It didn't go through. I mean, AstraZeneca got clobbered. Yeah. I mean, what, 13% one day, 10% the next day.
So, and hence the FTSE dropped quite severely.
Yes, it
did as well.
But again, look where it drops, okay? It drops horrendously one day, and then bounces back, to levels. I mean, what was the Dow? 170. Yeah. After selling off. So, and I think that's where, looking at the clients, they have to put very tight stops in. But one of the things to look at is, again, looking at client surveys, over the last 46 weeks, we've had 46 consecutive weeks of positive cash inflows into the Eurozone, okay? Hence the reason the Euro, 136, 137, almost 140, the DAX, the CAC, Iran, et cetera, And one of the things has been the incredible appreciation of bank stocks. I mean, if we remember 3 years ago when we were talking Brexit, in Greek yields were 482% or something. Well, the banks were getting killed because they were making no loans, so they've been buying bonds, and they had to mark to market. Each day they had to mark to market, down, down, down. And of course, I mean, within the last last week in 10 days, we've had historical lows on Portuguese bonds, Italian bonds, Spanish bonds, etc. So that's helping the bank stocks. But it really is going to reach a point where you're also seeing, just like last week, I think you had a 14 basis point drop, or increase in Italian yields, because everybody said it's just too rich. So where did they go? They didn't go out of the bond market, they just went into the treasury market.
Excellent. So carrying on with sort of the euro field to this, we have some UK GDP figures today. Sort of came out sort of as expected. Do you see the Bank of England looking to increase rates anytime soon, or
well,
is everything
I
just
think
going as
one of the
expected?
things that we're starting to see, again, everybody is voting unanimous for no more QE and no change, but we're starting to see some of the people, whether it's the housing bubble, forget the housing bubble, the concern now is how much slack is there in the economy. One person, the numbers, he thought it was 0.9. Another one was saying it could be 1.5 to 2. So that's going to be the key here. Okay. Also, remember, I think we have a change in minimum wage or something like that sometime soon. So how will that affect the employment? Now, my official, Markets.com's official, feeling is the Bank of England will not raise rates until at least February of next year. But I will have to say, looking where sterling's been, looking at the economic data over the month, I've gone from probably about a 35% probability to almost a 50-50 chance they could move as early as December.
Okay. And with the euro, it's kind of, for me, sort of 1 week there sort of coming out and sort of everything seems rosy, and next week we're sort of talking about cutting rates again. How do you see sort of the Eurozone? Do you think they will?
Well, I think we will.
Yeah.
I think with Super Mario was very plain in his discussion, saying, well, we'll do everything possible. And then the following Monday, when even the Bundesbank said, we sort of changed that position. And I think even looking at the PMI numbers today, yes, they only dropped 0.1%. But you saw Germany go up to 60. You had France go below 50. And remember, all those years when it was, Germany and France and who are those other members of the European Union? But I think the thing that upset me or concerned me the most in today's data was the 0.9 drop in manufacturing exports. Well, why? If the European Central Bank was concerned about the euro at 134.33 in October, hence they dropped rates in November, they must have been, I can't say this on television, doing it to themselves when we almost got to 140. I know now we're at 136, I think 64 the last look. If you're a technician, 136.25 is a major 200-day moving average. And anybody that's been looking at, whether it be stocks, whether it be, again, the foreign exchange, everybody now is looking at the 50, the 100, and the 200-day moving average, whether they're going in the same direction or whether you're having an inverse relationship. So that is one thing that everybody will be looking at, 136.35. But as she just said, well, we have a bad day, but we still sort of 137, 137.02, 136.98. So that is really what's going to be looking at, okay?
Okay. And I suppose finally, just sort of what we're sort of seeing in the news a lot recently is sort of IPOs.
Yeah.
And, with the likes of Alibaba and Saga and sort of going back to Royal Mail.
What are your clients saying about Alibaba? Because that's what they keep asking our people, okay? I just wrote something about it,
Yeah.
And you're looking at the last 6 or 7 Chinese IPOs, and that's looking like trade rates like $10 billion. Well, they all, like everywhere else, like Royal Mail, they all went to the moon. But now if you look at the price is at or considerably below, the initial offering price. And there have only been a couple, maybe, like Royal Mail, that's still way up there, okay?
Yeah.
Maybe Poundland, but Pets at Home and Boohoo.com and Exxon Media. When they reach a certain level, everybody sells them. Now, I will have to say, because of my advanced age, I got preferential treatment on Saga. I saw one of your competitors, I think, was quoting $255 today is a gray market price.
Yeah.
I think the paper seems to think instead of it being 185 to 245, they'll probably get closer to maybe the 2. And of course, it's been, I don't know what oversubscribed means or not, but again, all the employees, and then again, you put 8.5 million people like myself that have car insurance or home insurance with Saga. So we got a, guarantee, and whether you saw it or not, if we hold the stock for a year plus, okay, for each 20 shares we bought, we get 1 free share, and of course to participate in the dividend. So again, I never look to be a speculator, but I mean, like with Royal Mail, and I think I got 233.6 shares or whatever stupid number it was, right? Well, I mean, I didn't sell it immediately, but when it got to 700p, I said, well, you got to sell it, okay? So I think what you're looking at is this will continue to go, because what you're starting to see is a number of these, whether you want to call them hedge funds or capital groups or something like that, why not take advantage of at all-time historical levels? And even if you look at PE ratios, most of these indices are not that rich. I mean, even if Alan Greenspan says he doesn't see, and if he were, these are my words, if he was still Fed chairman, he would not be concerned with U.S. stock indices being overheated. Now, back up to one thing. I am concerned about the 8.4 million mortgage people in this country, okay? Because now you have the largest percentage of mortgages fixed to the base rate, okay? It was 25 before Lehman, but now it's 38. So yes, we've had, amazing consumer spending, but, if pay rises still only 1.7, 1.82 or something like that. But if you're now paying, say, hello, early Christmas, I don't know what the first Thursday of December is, say it's the 5th of December, and we get even just a 25 basis point rate hike. Well, it may not sound like much, but I mean, if you're shopping at Aldi or Lidl or something, and you're not paying 50, 60, 100 quid more a month, for your mortgage, okay? Your heating bill, your electricity bill, your this, that, and the other is not going to change. Will that have a cooling effect on the economy? And I think this is one of the things where Carney keeps talking about the housing market, where, as we saw in the minutes, most of the members that were concerned are more concerned about the validity of the slack in the economy.
So yeah, do you see the housing bubble? How do you see the housing bubble? Is that going to be an issue?
Well, I mean, the housing bubble has been an issue in this country since 1945, pre-Lehman. Okay, before the mortgages all went ballistic. I mean, we were still probably 50 to 60,000 houses short. Well, how many more people do we have in this country since Lehman in the last 5 years? Most people, depending on who you talk to, we're 150 to 300,000 houses short. And I mean, all you have to do is forget the housing market. It's the same thing is happening in New York City especially. Look at the rental market, okay, especially now with the 30 to 35-year-olds, if Lloyd's just changed their deposit levels, I think, yesterday. I mean, if you can't find, okay, how many people are going back home living with, mom and dad? And look at the rental market. The rental market is going sky high. I mean, prices you couldn't believe, okay? New York and also here. I mean, I don't know about Runcorn or Halifax or, Devon or Cornwall. So the market will continue to increase. And I mean, again, looking at some of the big movers in the stock market, both here and in the U.S., have been housing and housing-related companies.
It's true. Well, I think we'll leave it there.
Brilliant.
Yeah, thanks very much, Bill.